Welcome back to The Explainer. I am absolutely thrilled you're here today because we're tackling a massive, incredibly complex topic. But, we're going to do it the way we do best, strictly through the data, the structure, and the blueprints. Today, we're examining the architecture of American student debt relief. If you're a focused learner looking to understand exactly how this massive system operates under the hood, completely cutting through the noise of the daily headlines, well, you are in the perfect place. We're going to break down the mechanics of this system and map out exactly how student loan forgiveness is engineered in the United States. So, how is debt relief actually built? We hear terms like student loans and forgiveness tossed around constantly in political debates, right? But today, we are stripping all of that politics away. We're going to put on our hard hats and look purely at the structural mechanics of the system. I want you to think of American student debt not as a political talking point, but as this sprawling, complex skyscraper. We want to figure out how the foundation was poured, what materials are actually holding up the load-bearing walls of debt relief, and how the entire structure is designed to function for the borrower. Okay, let's dive into this. Here is our architectural floor plan for today. We'll hit the blueprint of student debt, designing the foundation, the structural pillars of relief, navigating the framework, recent policy renovations, and finally, the future skyline. Let's get building. Part 1. The Blueprint of Student Debt. $1.7 trillion. To really put that into perspective, that structure towers over both total U.S. credit card debt and auto loan debt combined. It's just a staggering figure, and it's absolutely crucial that we ground ourselves in the sheer scale. Think about it. If this debt were a physical structure, it would cast a shadow over the entire American financial system. Understanding that these relief programs operate within a $1.7 trillion ecosystem explains exactly why the architecture of these programs has to be so incredibly complex and why altering them is such a massive, heavy-lifting bureaucratic undertaking. Now, when we say student debt, we actually aren't talking about one uniform monolith. The vast majority of this structure, nearly 93% of it, is comprised of federal loans, which are managed and held by the U.S. government. The remaining 7%? That represents private student loans from banks and private lenders. And this distinction is literally the most important structural division in the entire system, because the relief architecture we're about to explore is almost entirely built on that federal side. Moving right along to Part 2, Designing the Foundation. Let's pour the concrete here and define our terms. Student loan forgiveness in this specific architectural framework is not just erasing a number on a screen. It is the official legal discharge of a borrower's obligation to repay their remaining balance. But, and this is a big but, it is granted only after incredibly specific legislated conditions are met over a set period of time. It's a contractual mechanism built directly into the promissory note of federal loans. It's designed to be a release valve for sure, but only for those who follow the specific structural pathways to reach it. And this is exactly why that federal versus private distinction is so critical. Federal direct loans are built on a foundation with statutory relief options designed right in. They're built with flexibility in mind from day one. Private student loans, however, are entirely different buildings. They're governed strictly by private contracts and have virtually no structural forgiveness options whatsoever. So the relief architecture we are discussing today structurally excludes private loans. It's just a vital feature of the blueprint. The foundation works to support federal borrowers, but it essentially leaves private borrowers outside the framework. Part 3. Structural Pillars of Relief. According to our source data, the federal architecture primarily relies on two core load-bearing pillars. The first one is income-driven repayment, or IDR. This pillar is designed to flex based on a borrower's financial reality. It ties monthly payments directly to income and family size with a promise of forgiveness after a 2-decade timeline, usually 20 to 25 years. The second pillar is public service loan forgiveness, or PSLF. Now, this one is built on the concept of service. It offers a much faster route to forgiveness, usually just 10 years, in exchange for the borrower dedicating their career to public service or nonprofit work. Together, these two mechanisms form the structural core of American debt relief. Let's look closer at how this builds. Qualifying for that PSLF pillar is not an automatic process at all. It's a highly specific bureaucratic staircase. Step 1. You absolutely must have the correct loan type. Step 2. Secure eligible full-time employment with a public service or nonprofit employer. Step 3. Enroll in a qualifying income-driven repayment plan. Step 4. You have to make precisely 120 qualifying payments. And finally, Step 5. Submit the ultimate certification. If a borrower steps out of sequence, say, actually, they have the wrong loan type, or they're on the wrong repayment plan, the structural integrity of their relief fails, and they often have to start all over again. Which brings us to Part 4, navigating the framework. Basically, the blueprint versus the construction site. So the crucial point is this. On paper, the blueprint is perfectly logical, right? You make the payments, you get the relief. But practically, out on the construction site, borrowers face an absolute administrative labyrinth. We're talking about loans getting handed off between multiple private servicing companies over decades, leading to lost paperwork, uncounted payments, and processing systems that literally crash under their own weight. The structure is so complex that the system itself often struggles to keep accurate track of who has actually met the requirements. It gets so incredibly dense that, according to our source material, navigating this highly intricate architecture often requires the average borrower to act simultaneously as an actuary, a legal scholar, and an archivist of their own financial history, just to secure the statutory benefits they were legally promised. The burden of proving the building is safe basically falls entirely on the tenants. Part 5. Recent policy renovations. Acting purely as neutral building inspectors here, we can map out the chronological updates to the system over just the last few years. Back in 2020, we saw an unprecedented system-wide payment pause, which essentially put the entire structure into a state of suspended animation. By 2021 and 2022, the government recognized those historical administrative failures we just talked about, and they implemented temporary waivers to retroactively fix miscounted payments. Then in 2023, as the pause finally ended, we saw the rollout of newly renovated income-driven repayment frameworks designed to fundamentally alter how those monthly payments are calculated going forward. And this brilliantly illustrates exactly what changed. The math inside the architecture has been radically altered. Under the old framework, borrowers paid 10 to 15% of their discretionary income. The renovated framework slashes that down to 5% for undergraduate loans. The old framework protected income up to 150% of the poverty line. The new one protects up to 225%, meaning way less of a borrower's income is even considered for repayment. But even more structurally significant, unpaid monthly interest is now waived, preventing the total loan balance from endlessly growing, which, as we know, was a major structural flaw in the old blueprint. Finally, Part 6, the future skyline. Let's look at the long-term trajectory. Looking at the projections based on these renovations, the skyline is definitely shifting. The data indicates that we're going to see a significant decrease in average monthly payment obligations for millions of borrowers. Concurrently, because the pathways have been widened and the math has been made more generous, we're projected to see a massive increase in the total volume of debt that actually reaches those statutory forgiveness milestones over the next 10 to 20 years. Structurally, this represents a major transfer of the financial load, shifting the long-term cost from individual borrowers back into the broader federal loan portfolio. Which leaves us with this final, incredibly vital question. What is the future structural integrity of American student debt relief? We've seen how the blueprint was drafted, how the pillars were erected, and how recent renovations have drastically altered the floor plan. But as legal challenges and policy debates continue to swirl around these renovations, will this new architecture stand the test of time? Or are we looking at a system that's going to require constant ongoing reconstruction? That is something anyone studying the American financial system has got to keep an incredibly close eye on. Thank you so much for joining me today on The Explainer. Keep learning, keep asking those big questions, and I will see you in the next one.